Some level of stabilisation is now expected in the property market following 2 consecutive decisions to pause the recent interest rate hiking cycle. This is according to the FNB Commercial Property Broker survey, which, however, also notes that further weakness is still perceived. Weak sales activity has been reported in the industry as a result of the current economic climate. Property sector strategist John Loos speaks to us about this. Thank you so much for your time, John. So a mixed picture of activity. Talk us through what the survey tells us.
Well, yes, this is a survey of sales activity more than rental markets and vacancy rates as such, or this part of it. Firstly, we survey the brokers and we ask them a business confidence question. Is the level of business activity acceptable or satisfactory to you or not? It's a yes or no answer. And it's improved somewhat in the third quarter survey from 33% of respondents in the previous quarter to 42%. But 42% still means 58% are not satisfied with business conditions. So it's not a wonderful picture yet, but there was some improvement in that reading. Then we ask them for a perception or an experience of activity, an activity rating on a scale of 1 to 10. The industrial component, the highest, 5.44, but did decline from the previous quarter. The retail component, 4.02, the worst of the lot, declined from the previous quarter. But then the office component, which has been weak for some time, at 4.24, that was a slight improvement from the previous quarter. So it's sort of becoming a bit directionless at the moment, I think, as we change from a previously declining trend to possible stabilization. You see one sector going up, 2 going down. It's a more confusing picture. And I think that's a sign that it's starting to level out at its weaker levels after some decline as a result of interest rate hiking that happened till earlier this year.
With that said, and the mixed picture of activity, how much of it reflects and represents sentiment?
Oh, no, I think a lot. I mean, I think we know where our economy is. Our economy has been on a broad stagnating path for over a decade. It's taken the knock of COVID-19 and with a muted recovery. If we look at GDP growth for this year, 0.2% year on year in the first quarter, a very weak number. A little bit better in the second quarter as load shedding eased. It was 1.6% year on year. But those noughts and ones are not good economic growth figures, and it's economic growth at the end of the day, along with interest rates, which are higher now, which drive not only business confidence but also property market performance too. So I think it's this mediocre to weak situation that still prevails is very much reflective of the overall economic environment and business sentiment in the country at the moment.
And of course, that then affects the near-term outlook. Are we likely to see this mix of a picture going forward into the rest of this year, especially because the dynamics have changed, John, since the times of COVID-19?
Well, yes, I think we'll still see this mixed, this pretty mediocre property picture for the rest of the year, because we don't expect interest rates to decline just yet. We still, and the full impact of interest rate hiking that happened still has to come through into the economy. So nothing to write home about this year. Next year, however, we do start to see, we expect mild interest rate reduction towards the latter half of next year. So it's some time to wait. But then we do expect some mild stimulus for the property market as interest rates start to go down. We think they've peaked and will start going down, but that's some time to come. And then we'll see perhaps some noticeable strengthening in the demand for property.
What's to be said about the impact of load shedding on the property sector? It changes how a business or a commercial property is going to be bought, and for what reasons?
Yes, that's proved tough for property owners and tenants alike. Load shedding affects as an indirect impact on property demand because it weakens the economy. It has a weakening impact on the economy. So that's the indirect impact. The direct impact has been operating costs. The tariff increases have been exorbitant over the past, more than a decade, and this year again. And then, of course, there's that reliability of electricity supply, which means that tenants, landlords alike have to work to put in alternative sources of power supply, which are often quite costly. So it's driven the operating costs up as well. And it's also what we've seen in recent quarters surveys is it started to drive the move by the search by owner occupiers. Many selling, and the motive for selling or key motive for selling has often been to relocate to an area where services work better, whether it's electricity supply or municipal services. There's a search for locations where things work better. So it's been a load shedding along with the broader municipal services and utility services has been a key influencing factor in where people locate to, sometimes across the country to places like the Western Cape. So, yeah, we do see the impact in property.
Lastly, John, for the retail property space, I imagine that it's trickier than any other in terms of an element in this particular space of the property industry. You can't simply move a business or a retail shop as quickly as you snap your fingers. What's to be said about how they are faring?
Sure. No, retail is where the clientele is, I guess. Although I must say that the Western Cape, which has benefited from 2 decades of strong semigration of skilled labor and looks like its economy is starting to outperform the others, there we're starting to see demand exceeding supply for in terms of investment in retail property. It's a stronger retail property market there, whereas in other parts of the country it's weaker. But yes, you generally have to go where your clientele goes. And many retail markets in the cities are already the markets are saturated with retail space. So where there has been some move, besides certain regions being stronger, is to rural and township retail over the past decade or so. You've seen there's been an undersupply. The markets haven't been saturated, and that's where some of the new investments have been, especially in rural, sort of low-income rural retail. That's done quite well in recent years.
Thank you so much for your insights. Property sector strategist at FNB, John Loos, talking to us this morning on the business desk about movements and activity within the commercial property space.